Imagine pouring billions, literally billions of dollars into an investment, hoping to get rich. But what if there's like this secret showdown happening, deciding which one actually makes you richer?
Uh-huh.
Today, we are diving deep into the ultimate face-off. Dividend ETFs versus growth ETFs. You're with Channel Vest. This is your analysis.
Precisely. And our mission here, well, it's to cut through all the noise and answer that one big question for you, which will potentially make you richer in 2025.
Yeah, is it a dividend ETF or a growth ETF? We're putting two titans head-to-head, Vanguard's VIG and VUG.
Right. Two very popular choices.
Now, super important heads up right at the start. Everything you hear today, it's purely for educational purposes, okay?
Yeah, definitely.
This isn't financial advice. You absolutely should talk to a qualified financial advisor before making any investment decisions. And remember, what happened in the past doesn't guarantee future results.
Didn't stress that enough. But what we can do is give you clear insights. We'll break down the fundamentals, look at performance, the risks involved.
And even get into some data-driven predictions for 2025. Stick with us.
Okay, so let's talk scale. We call this the $289 billion question because look at VAG, the Vanguard Dividend Appreciation ETF. It's managing, what, $102 billion?
$102 billion. That's already huge. But then VUG, the Vanguard Growth ETF, it just blows that away with $187 billion under management.
It's massive. Absolutely massive.
It's insane.
Huh.
Investors have poured almost $300 billion into just these two. So the big question for your portfolio is, which one really has the edge?
And that's what this deep dive is all about settling. So what's the roadmap?
Right. First up, ETF fundamentals. We'll get into the core differences, dividend versus growth.
Then performance analysis. How have they actually done over time?
Next, crucial stuff, risk assessment. How do they hold up when things get rough?
And the big one, 2025 predictions. We've got data-driven forecasts. You really won't want to miss this part.
Definitely not. Okay, let's meet the contenders. In this corner, VIG, the Vanguard Dividend Appreciation ETF.
Right. So VIG's strategy is all about companies with a track record, a history of increasing their dividends year after year.
And it's pretty spread out, right?
Yeah.
338 different companies, lots of sectors. Plus, the cost is super low, just 0.06% expense ratio.
Super low. Now, in the other corner, VUG, the Vanguard Growth ETF.
This one's different. It's targeting companies expected to grow faster than average. Think innovation, expansion.
Exactly. And it's much more concentrated, especially in tech. We'll get into that. The expense ratio. Even lower at 0.04%.
Wow. Okay, so right away, you can see they're built differently.
Totally different philosophies. Now, context is key for any forecast. Let's quickly paint the picture, the 2025 market environment.
Okay, what are we looking at?
Well, our analysis suggests U.S. GDP growth is kind of stabilizing, maybe around 2.2%. Inflation seems to be cooling off, maybe near 2.7%.
And the Fed? What's the vibe there?
The signals are leaning neutral to maybe slightly bullish, which, impacts everything.
Right, and market trends. What's hot right now?
Tech and growth stocks are definitely still outpacing value and cyclical sectors overall. There's some chop, sure, but the big money flows. They're heading straight for AI, semiconductors, cloud computing.
You see it everywhere. And that directly hits these ETFs.
Absolutely. And investor sentiment. It's interesting. Big institutions, they seem to have a high appetite for risk piling into tech.
Right.
But at the same time, you're seeing dividend stocks, those quality companies, starting to look attractive again as people look for defense. So it's a bit of a tug of war.
Fascinating. Okay, let's get to the juicy stuff. Performance. Prepare yourselves for shocking performance differences.
Yeah, this is where it gets pretty stark. We look at the historical data, 1 year, 3 year, 5 year, 10 year.
Don't keep us waiting.
VUG has just, it's crushed VAG. Across all those periods, in terms of just pure returns, it hasn't been close.
Whoa. Okay, so VUG has consistently delivered way higher returns, period. That's huge.
It is.
But wait, like we always say, returns aren't the whole story, right? This immediately makes you ask, what about risk?
Exactly. That's the critical next question. Higher returns often mean higher risk. So how does VUG stack up there?
Let's see the numbers. Volatility.
Right. Volatility, how much the price bounces around. VAG comes in at 13.1%, generally smaller, more stable swings.
Okay, smoother ride. And VUG.
VUG shows 18.4% volatility. So definitely bigger price movements, sometimes, wilder swings.
Okay, so more potential for ups and downs. What about beta? How sensitive are they to the market?
Good question. VIG's beta is 1.82. That means it's actually about 18% less volatile than the overall market.
Less sensitive. Makes sense for dividend stocks.
Right. VUG, its beta is 1.08, so it's about 8% more sensitive than the market.
Ah, okay. So the takeaway is pretty clear then. VUG gives you higher returns historically, but it comes packaged with significantly more volatility and market sensitivity, more risk.
That's the trade-off, plain and simple. Higher potential reward, higher potential risk.
So why are they so different in risk and return? Let's look under the hood. What's inside these ETFs?
This is where you really see the strategies diverge. VIG's top 10 holdings, they make up about 30.2% of the fund.
And who's in there? Big, stable names.
Yeah, exactly. Think Apple, Microsoft, Broadcom, but also Johnson & Johnson, United Health, Visa, Procter & Gamble, Home Depot. Solid quality companies.
Got it. Diversified blue chips, many of them. Now VUG.
Whole different story. Its top 10 holdings, a massive 60.8% of the entire ETF.
60%. That's incredibly concentrated.
It is. And look who's at the top. NVIDIA at 12.65%, Microsoft at 12.19%, Apple at 9.49%. Then you've got Amazon, Meta, Tesla, Alphabet.
Wow. Okay, that is a huge difference in concentration.
Yeah.
It's basically riding hard on a few huge tech names.
Precisely, and that concentration directly amplifies both the potential gains and the potential losses.
Which leads us straight into the sector breakdown, the real difference. VUG isn't just growth, it's basically...
It's a massive tech bet.
Yeah.
Plain and simple. Over half its assets, 52.77%, are in the technology sector.
They're 53% in tech. Go to VIG.
VG is much more balanced, only about 24.1% in tech. VAG has significantly more in financials, healthcare.
While VUG leans more towards communication services and consumer cyclical, right? Those growthier areas.
Exactly. This sector split is probably the single biggest structural difference between them. It's where their paths really diverge.
Okay, but what about people who need income now? Dividends. Let's talk the yield difference.
Crucial point. VIG, being the dividend appreciation fund, offers a respectable 1.7% dividend yield currently.
Okay, 1.7%, not super high, but solid current income. And VUG.
VUG's yield is minimal, just 0.43%.
0.43%. So VIG provides, wow, nearly 4 times more current income than VUG.
4 times more, yeah. That's a massive difference if you're an income-focused investor or maybe in retirement relying on those regular payouts.
Definitely a key factor.
Yeah.
Okay, now for maybe a plot twist. We've seen VUG has higher returns, higher risk. VIG has lower returns, lower risk, more income. What about risk-adjusted returns? The truth.
Yes. The Sharpe ratio. This measures how much return you get for the level of risk you take on.
Right, so what does it show? VIG Sharpe ratio is?
Plin?
Okay, and VIG's. Given it higher returns, you'd expect it to be much higher.
You would think so. But VOG's Sharpe ratio is 1.11.
Wait, 1.10 for VIG and 1.11 for VUG. They're practically identical.
Exactly. This is a surprising result. Despite the huge gap in absolute returns, once you adjust for the risk take and the volatility, they're almost exactly the same in terms of efficiency.
That's incredible. So VIG's lower volatility really does compensate for its lower raw returns on a risk-adjusted basis.
It absolutely does. It's a smoother ride, delivering almost the same bang for your risk buck, historically speaking. That's a massive aha moment.
Wow. Okay, we're uncovering some seriously powerful insights here.
Yeah.
This deep dive is packed. If you're getting value from this, you absolutely need to hear our next analysis.
Yeah. What's up next?
We're going to break down the top 5 AI stocks that some analysts think could potentially 10x your money in the next bull market. Seriously, you don't want to miss that.
Sounds intense.
So go ahead, right now, smash that subscribe button and hit the notification bell so you don't miss it.
Good call. Okay, back to VIG versus VUG. We talked risk generally, but what about the ultimate risk test? How they perform in market crashes?
Yes, when the market tanks, what happens?
Our analysis is pretty clear here. VITOs offer significantly better protection during major downturns.
Like when?
Think 2008, the big financial crisis, the 2020 COVID crash, even the 2022 rate hike pullback. In all those scenarios, VIG's losses were noticeably smaller than VUG's. It acts like a cushion.
Okay, so VG is the defensive play in a storm. But what about when the storm passes? What about recovery?
The flip side. When markets turn around and start ripping higher, especially in bull markets, VUG rockets higher.
Like significantly higher.
Oh, yeah. It captures that upside momentum way more effectively. Look at the recovery after the COVID crash in 2020. Over the next 18 months or so, VUG was up something like 43.6%.
43%. And VG...
Siege was up too, but only 18.6%, less than half.
Wow. And the recent AI boom.
Same story. 2023 into 2025, VUG soared 35.8%, while VIG managed 15.3%. So VUG really excels when the market's running hot.
Okay, so VIG protects more on the downside. VUG captures more of the upside. That makes total sense given their makeup.
And it brings us right back to the concentration risk in VUG.
That's 60.8%, the top 10, mostly tech.
Exactly. That huge concentration, combined with its tilt towards momentum stocks, means VUG really is kind of a tech fund in disguise.
Which, like you said, cuts both ways. Big potential gains, but also bigger potential drops if tech stumbles.
Right. VUG, on the other hand, with its 30.2% in the top 10 and balanced sectors, offers much more diversification, just structurally behaves differently.
Let's dig a bit deeper with factor analysis. What really drives returns? What factors are these ETFs exposed to?
Okay, so VUG shows strong exposure to quality and low volatility factors, meaning it tends to hold companies with strong balance sheets, stable earnings, maybe lower debt, that's the quality part. And low volatility means stocks that historically haven't swung around as much. That explains its defensive nature.
Got it. And VUG?
VUG leans heavily into growth and momentum factors. Growth means companies expected to increase earnings or revenue faster than the market. Momentum means stocks that have already been performing well tend to keep performing well, at least for a while. It also has a large cap bias.
So these underlying factor exposures are basically why they perform so differently in different markets.
Precisely. It's the engine under the hood.
Now, even though they're different, how much do they move together? Let's look at the correlation matrix.
Yeah, this is interesting. They actually have a pretty high correlation around 0.86.
0.86. So most of the time, they are moving in generally the same direction.
Generally, yes. But that 0.86 isn't 1.0, so there are differences. VUG itself is very highly correlated with the S&P 500, like 0.95. Almost moves in lockstep.
So what's the takeaway on correlation? Does holding both help?
It actually can. Because they aren't perfectly correlated, combining them or even combining VUG with other dividend ETFs that might have an even lower correlation, like say SCHD at 0.80, can potentially give you better diversification than just holding one.
Interesting. Okay, let's talk about something often overlooked. Tax efficiency. The hidden advantage. How do they stack up here?
Good one. For VUG, a lot of its return comes from dividends. If they're qualified dividends, they get taxed at lower long-term capital gains rates, which is nice. Plus, you get those distributions quarterly.
And those dividends tend to grow, right?
Yeah, historically, VIG's dividend growth has been around 3.2% annually on average, so that income stream can potentially keep pace with inflation over time.
Okay, that's VIG. What about VUG?
VUG is different. Most of its return comes from the stock price going up, capital appreciation. The beauty there is you don't pay any tax on that gain until you actually sell your shares.
Tax-deferred growth.
Exactly. Minimal tax drag while you hold it. So here's a PRO tippy from our analysis. For the best tax efficiency, many people consider holding VUG in tax-advantaged accounts, like an IRA or 401k, where that growth isn't taxed year to year.
And VV?
VG might be better suited for a regular taxable brokerage account, where you can take advantage of those qualified dividend tax rates on the income.
Smart. Okay, let's get an outside view. What Wall Street is saying, what are the big firms thinking?
Well, Morgan Stanley, for instance, seems pretty bullish on large cap growth for 2025, especially with the AI theme playing out. They kind of see VUG as a core holding for growth investors.
Makes sense. What about a more cautious view?
JP Morgan takes a slightly different angle. They see dividend ETFs like VIG as providing structural defense, kind of like ballast for a portfolio, especially if you think we're late in the economic cycle. They prioritize capital protection.
So growth focus versus defensive focus. What about Morningstar? They do independent ratings?
Right. Morningstar gives VUG high marks for its low cost and broad growth exposure, but they do warn about the potential for bigger drawdowns that higher risk. For VIG, they see it as a top choice for steady dividend growth, kind of an all-weather option.
Okay, so different perspectives lining with what we've seen in the data. Let's summarize the bull case for each ETF. Why would you be optimistic about VUG?
The biggest bull case for VUG is definitely the AI supercycle continuing. Its top holdings, NVIDIA, Microsoft, they're right at the center of it. Plus, you've got strong institutional buying, and if the Fed does cut rates, growth stocks historically have done really well.
Lots of potential tailwinds. And the bull case for VAG?
For VIG, it's about defense. If the economy slows or hits a recession, VIG should hold up much better. It's packed with quality companies. Plus, that consistent growing dividend income is really attractive, especially for providing inflation protection.
Okay, strong arguments for both. But we got to look at the other side, the bear case for each ETF. What are the worries for VAG?
Number one concern, valuations. Growth stocks, especially tech, are trading at pretty high multiples, maybe around 40 times earnings for VUG. That's way above the market average. It makes them vulnerable if sentiment shifts.
And sensitivity to rates.
Yeah, we saw in 2022, rising rates hit growth stocks hard. That's a risk. And just the risk that this incredible momentum could reverse.
Okay, those are valid concerns. What about the bear case for VUG? Why might it underperform?
The main risk for VIG is simply that growth continues to dominate. In a strong bull market, VIG will likely lag VUG, maybe significantly. Also, its 24% tech weight means it's not purely defensive. It still has some sensitivity to that sector.
And inflation risk for dividends.
Right. If inflation stays high, it could erode the real value of those dividend payments, especially if dividend growth doesn't keep up.
Okay, bull and bear case is clear. Now, the moment everyone's been waiting for. Based on everything, what are the 2025 expected returns?
All right, drumroll. For VIG, our analysis projects an expected return for 2025 of 9.24%.
9.24%. Okay, respectable. And for VUG?
For VUG, brace yourself. The expected return is projected at 25.07%.
25%. Wow.
Okay.
That's a massive outperformance expected for VUG next year.
It is. Now, it's crucial to understand why. That projection heavily relies on a scenario, which we assign about a 40% probability, where this AI and tech boom continues strong.
Got it. So it depends heavily on that specific outcome. And super important reminder, these are expectations, not guarantees.
Right. Absolutely not guarantees, just projections based on models and probabilities. The future can always surprise us.
Definitely. Okay, so VUG expected to outperform, but it's not a sure thing. For most people, it's probably not an all-or-nothing choice. What about the optimal portfolio mix?
Right. We ran Monte Carlo simulations looking at thousands of possibilities. For an investor seeking a balance between growth and managing risk, the analysis suggests an optimal blend might be around 80% VUG and 20% VIG.
80-20 VUG, VIG. Interesting. What kind of results does that blend target?
That specific mix aims for an expected return of about 16.44%, with volatility around 17.03%. The Sharpe ratio comes out to 0.701. The idea is to capture a good chunk of VUG's upside while using VIG to smooth the ride a bit.
Okay, 80-20 as a general optimal mix, but it really depends on the individual, right? Let's look at an age-based allocation strategy.
Yeah, this is where it gets really personalized. For a young investor, say 20 to 35 years old, with a long time horizon and high risk tolerance.
Next growth.
Pretty much. The suggestion is maybe 90% VUG, 10% VIG. Really lean into that growth potential.
Okay. What about mid-career, say 36 to 50?
Here, you might dial back the risk a bit. Maybe a 70 retirement, pre-retirement 51-65.
Now income and capital preservation become more important. The suggestion leans towards an equal split. 50% VUG on, 50% VIG, balancing growth and stability.
And finally, retirement, 65 plus. The focus shifts heavily towards income and minimizing drawdowns. Here, the suggestion flips to maybe 30% VUG, 70% VIG, prioritizing that stability and dividend income from VIG.
Perfect. That clearly shows how the optimal mix changes based on your stage in life and what you need from your investment.
Exactly. It's not one size fits all.
Absolutely.
Yeah.
Now, if you want to keep getting these kinds of insights and stay on top of market trends,
You gotta stay connected.
that's right. Make sure you follow us at ChannelVest on Instagram, Twitter, and TikTok. We're putting out daily market updates, stock ideas, investment strategies.
Good stuff to keep you informed between these deep dives.
Definitely. Okay, almost there. Let's quickly touch on a risk management framework. How can people manage the risks we've talked about?
Good practical point. First, position sizing. Our analysis suggests maybe capping any single ETF at 50% of your portfolio. Limit total growth ETF exposure like VUG to maybe 80% and keep a minimum defensive allocation, perhaps 15% in dividend ETFs like VIG.
Okay, diversification rules. What about stop-loss triggers? When do you maybe rethink things?
Yeah, having triggers can help manage emotion. Maybe consider action if an individual ETF drops 20% from its peak, or if you see a major breakdown in a key sector like tech, rising interest rates significantly, or the ETF's Sharpe ratio falling below a certain level, say 0.80, could also be triggers to review.
And rebalancing. How often?
A simple approach is quarterly rebalancing. Check if your target allocations, like that 80-20 mix, have drifted. If they're off by more than, say, 5%, bring them back in line. Or rebalance if the drift gets really significant, maybe beyond 10%.
Great actionable tips there for managing the portfolio. Okay, let's bring it all home. After all this analysis, the verdict ET, which will make you richer.
All right, the bottom line. If your goal is maximum growth potential, especially if you believe the AI boom continues strong into 2025, VUG is the ETF more likely to deliver those higher absolute returns. It's probably best suited for younger investors with that long timeline and high risk tolerance.
Okay, VUG for max growth. What about balanced returns?
For most investors looking for that optimal blend of growth participation and some downside management, that 80% VUG, 20% VIG mix seems to hit the sweet spot for risk-adjusted returns based on our analysis.
80-20 for balance. And finally, for income and safety.
If your priority is stability, capital preservation, and consistent income, especially in retirement, VIG is the clear choice. It offers superior downside protection and that reliable dividend stream.
Perfect summary. So let's quickly nail down the key takeaways for everyone listening. 4 main points.
Okay. 1. Returns versus risk. VUG historically offers higher returns, but definitely comes with higher volatility and risk. VIG is the opposite.
2. Sector exposure. This is huge. VUG is a massive bet on technology. VIG is much more diversified across different sectors.
3. Market protection. VIG shines during market crashes, offering significantly better downside protection. VUG rockets higher in recoveries.
And 4. Optimal strategy. There's no single answer. It depends completely on your personal situation, your age, your goals, how much risk you can handle. But for many, some kind of mix of VUG and VIG offers the best balance.
Well said. That really covers the core findings.
So after diving deep into all this incredible data, comparing these two titans, here's the big question we want to leave with you.
Uh-oh, homework time.
Haha, yeah. If you had to choose just one ETF, VND, or VUG to hold for the next 10 years, knowing everything we've just discussed, which one would you pick? And more importantly, why?
Ooh, that's a tough one. Really makes you think about your own convictions and risk tolerance.
Yeah, exactly. Let us know your answer and your reasoning in the comments below. We genuinely want to hear what you think.
Yeah, definitely curious to see the responses on that one.
Awesome. Well, that wraps up this deep dive. Thanks so much for joining us.
Thanks, everyone. See you next time.